Hey everyone, my name is Aman, and in this video we will discuss when to sell a stock. Now, buying the stock is the easy part, but knowing when to sell requires much more work. It could be a stock that has given exceptional return in a very short period, which scares you, or it could be a loss-making stock. Now, in this video we will try to simplify the process of selling a stock. So, what are the four reasons basis which you can consider selling a stock? Now, this topic is fairly difficult to teach, so I have tried my best. But if you still have problem understanding something, do leave it in the comments. To grow money successfully, one must buy the stock with the absolute knowledge of the objective of buying it in the first place. If, for example, I buy HUL for the sole reason of it being a defensive stock. Defensive stock is something that gives constant return regardless of market downturns. So there might be phases when the stock itself is overvalued and it might even correct 5 to 10%. But unless the fundamentals of the business change, or if it stops serving its purpose as a hedge against volatility, I shall keep it, or else I would just sell it. Now, another example would be the private banking sector. I consider this sector to be extremely deeply undervalued. For example, HDFC's bank revenue has grown more than 30% this year, and profits have grown at a 3-year CAGR of 26%. The stock price has still been the same in the last 4 years. This shows that the stock is quite undervalued. The PE is also much below what it usually is for HDFC. So once the PE crosses its median PE, I would sell some of my HDFC shares, if not all, as the purpose has been served. The second reason why you can consider selling a stock is if there are fundamental changes. So these fundamental changes could be of multiple types. This could be a fundamental change in your investment thesis. So for example, if you thought that India's growth story is going to be fueled by the IT sector earlier, but now with maturity, maybe you think that it's going to be the manufacturing sector. Or it could be, for example, when you started out, you had a higher risk appetite, but with age now you're more risk averse. So this is a fundamental change in one's investment thesis. There could be fundamental changes in the business. Let's take ITC for an example. So they have pivoted and diversified their portfolio out of the tobacco industry to a large extent, which you think is a good decision. But suddenly tomorrow they come out and they say that we're going to double down our tobacco industry business. So this could be a fundamental change in business. A fundamental change could also be a sudden change in the CEO, or the company not reporting good quarterly results as you expect it to do, or they have taken up a lot of debt, or it could also come from the government. So for example, if you're a big proponent of the gambling industry in India, and tomorrow government comes out with some unfavorable regulations, or they impose too much tax on these businesses.
Nifty had gone up by close to 121% from September 2019 to September 2024. This had got a lot of people thinking that the market could crash from this point forward, and it has been corrected by close to 12% already. So if we look at Nifty 50's PE, it seems reasonable. So I don't think that it will fall dramatically from this point forward. And it has entered a time correction, which means that it has been moving sideways in a range for a while now. So until the PE goes down and companies start reporting good results, and when it has generated enough momentum, it will break out, and this will start another leg of a bull run.
Now everyone at all times is conflicted as to where Nifty is headed. And if you are of a belief that you will let market fall a little, and when it corrects, that is when you will build a massive portfolio and be a millionaire, this is absolute nonsense. Nobody can time the market. So try to be 80% invested all the times and keep 10 to 20% of your portfolio in cash. This is in case if a stock that you like is selling for cheaper. Now, if I had no exposure in the stock market in the current scenario, I would deploy 80% of my money regardless if the market is cheap or expensive. Why? Because far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. This was quoted by Peter Lynch, who is a legendary investor. Coming back to the topic, when you think that the market is overvalued, liquidate 10, 20, 30% of your stock portfolio, whatever gives you confidence, and deploy that money if the correction occurs. So if in case you were to go wrong and the market rallies, 80% of your portfolio will still bring you profits. Now, if markets are undervalued or overvalued, don't just go and sell everything or buy everything, but play around with that cash part, that opportunity fund part, the 10-20% that you've liquidated. The same logic goes with individual stocks. So HUL, for example, I hold it because it serves me the purpose of a defensive stock. Also MapmyIndia, I have a long-term bet on its business. So if I had 10 shares of HUL or MapmyIndia and I think it to be overvalued, then I'll go and liquidate 2 or 3 shares. And if the market was to fall and if the price seems fair, then I buy those 2 or 3 shares back.
The final reason when it is justified to sell is if you have found an alternate opportunity which might generate better returns. Because whenever you sell, you face something called a reinvestment risk. So we'll take an example here. So if you had invested in a company called X because it was undervalued and it has given you 50% returns in 2 years, but now it is trading at a fair value and is no longer undervalued. So it only gives you 12 to 15% CAGR. So should you sell it? If you decide to sell it because it has served its purpose, as I mentioned before, but aren't able to find a better investment to rotate your money into, then you will face reinvestment risk because you have sold a stock that was giving you 12 to 15% CAGR, but you haven't been able to find an investment that could mimic, if not outperform those returns or give you similar returns with lesser risk. Now, if X had gone from undervalued to overvalued, it would be wise to sell. But if it is trading at a fair PE, you should only sell if you have found a better opportunity. Let's take another example. Both HUL and ITC are defensive stocks and are in the FMCG space. Now, if there comes a time when ITC is deeply discounted, then rotating all my money from HUL to ITC wouldn't be wrong because I have found a better opportunity. I hope this video gave you at least a little clarity on the things to keep in mind while deciding to sell a stock. If you learned something new, do press the like button. Thank you.